Well, hello there, my friends. Chris Marcus here with you on Friday, February 2nd for this week's weekly Arcadia Market Wrap-Up. Of course, if you haven't already done so, hit that subscribe button so we can keep you posted on the incredible developments happening in the market by the week. Man, the dollar is continuing to take a pounding and a lot of exciting news happening this week. So let's just dig in. First of all, fascinating week. We finally saw the U.S. stock market go down. Just when you were beginning to wonder if it only went up on Friday, it was down over 600 points. Either Tuesday or Wednesday, it was down about 300 points as well, with at least the mainstream media talking about people being concerned about rising interest rates. And well, certainly they should be. And you can take a look here. Let's pull up our benchmark 10-year bond chart. And as you can see, well, that's the 1 year. It got hammered again today. Keep in mind, rising yields essentially means the price is lower. And you can see in the last month, quite a big move from about 2.46% up to 2.84%, and just a couple of reasons why this might be happening. Again, the Fed claims they're going to raise interest rates. Again, they did not do that this week, although they said they're going to. And of course, there's the rumors out of China that they're stopping buying as many of the bonds as they have been. So if that's the case, rates are going to rise. And the reason we're in this situation and talk about the collapse of the dollar is that as rates go up, you have an economy that is not, it's not built to handle that, because there's so much activity that's been generated just because of the lower rates that becomes insolvent when you get higher interest rates and the payments become unaffordable. Simplest way to put that in perspective is just think back a decade. Lowered rates, people took out a lot of mortgages. When rates went up, you had the subprime bubble. Of course, all of the amounts are bigger now. So certainly worth keeping an eye on. I've been pretty stunned at how quickly this yield is going up. Whether that continues, who knows? Again, the more pressure this puts on the stock market, then of course, what is the Fed going to do? Well, they're going to start printing even more money to bring it back down. So, not an ideal situation. And in terms of whether we actually see a stock market, bond market, and real estate market crash, we'll have to see that at some point. Now, whether the actual numbers come down, this gets into the difference between a nominal or a real crash, where let's say the Dow Jones goes from 25,000 to 50,000, so it's doubled. But if so much money is printed to push it up there that everything that you buy is tripling or quadrupling in price, then in nominal terms, the stock market went up, but in what's called real terms, in other words, what you can actually buy, you've gotten clobbered. So this is why these are all these factors that we're always getting at and how they're combining. They're not unrelated. And when you see how they're all fitting together, again, let's take a look at another news story we had here. New fiscal worry, too much short-term borrowing as deficit climbs. Even the Wall Street Journal finally checking in and noticing what's going on. I wish they had called me about 5 or 10 years ago, because I've been sitting here writing about that specific problem for quite a while. And even mentioned in one of the monthly market snapshots how, typically when rates are low, a lot of people refinance the mortgage, lock in a low rate, and you always kind of wondered, well, maybe you didn't, or maybe you did. I always wondered, well, why wouldn't the government do it? They have all this debt. Why not lock in the low rates while they're still low? Short answer is because you can't trade with yourself, and if the Fed stops buying the debt, and the US actually tried to refinance that, the market would collapse probably pretty instantly. So here is the dollar index chart. Again, this measures dollar against other currencies that are doing their own best effort to hyperinflate, such as the euro and the Japanese yen. So again, it's just fascinating seeing how much it's been sinking even compared to that basket of paper. And then, of course, when you wonder what would it be doing against any sort of currency that has a limited supply, we've seen the answer in the crypto market, which, speaking of which, let's take a look at the cryptos. Certainly, for anyone who owns cryptos or has been watching, it's been a pretty brutal week in the crypto space. As you can see, a lot of red there. My dear beloved Litecoin down to 130 bucks, Bitcoin at 8,600, and certainly some panic in the streets. Although, you know, that's kind of what's going to happen in the Bitcoin and crypto markets. That's what's happened since their inception. It's an emerging asset class. It's an incredibly fascinating situation that not many people really understand and grasp how the assets fit in with what's happening politically, why Bitcoin was designed specifically in response to the money printing. So with that said, you have some big moves, and while a lot of people are talking about the end of cryptos and how they're plummeting, keep in mind Bitcoin was $1,000 at the beginning of 2017, and it's still up eightfold plus a little more, as are most of the cryptos. So as someone who owns some cryptos, what do I plan on doing is pretty much nothing, because none of the fundamentals have changed. It's not like the dollar is getting better. It's not like all of a sudden the US Treasury has sorted things out. It's not as if the political scandals, the pay for play, Uranium One, it's not like any of these things are being discredited. In fact, more evidence is emerging. So at least as far as I'm concerned, this is part of the trading volatility. And if you have not gotten involved in cryptos, I would think that this would be a great opportunity to do so. Again, I'm not giving trading advice, but just my own perspective here. And certainly if you're wondering why, that's what I cover a lot in the monthly market snapshot. I actually just finished writing February's earlier tonight, so that will be available on the Arcadia website soon. If you want to get a little bit of a better understanding of how I see these things fitting together and why I believe that despite this down period in the cryptos, that are still good times ahead. And the last story of today, something I've been covering and writing about for years, the manipulation in the gold and silver market, where the prices of gold and silver around where they were in 2008, when basically every other asset on the planet has doubled or tripled, largely because you have banks basically selling whatever amount of paper is necessary to keep the prices low. Of course, for a long time, anyone who said that was just labeled a conspiracy theorist, which is fine. I'm okay with that, but just for whatever it's worth. Here, U.S. fines Deutsche Bank, UBS, and HSBC fines and charges of manipulating futures market in precious metals. And there's a quote down here that I would like to see if I can find. Perhaps it wasn't in this article, but one of the things in the actual CFTC press release they mentioned was spoofing to trigger stop loss orders, which is what I, as well as several others in the gold and silver community, have been talking about for years. Essentially, keep in mind that the banks that trade in the gold and silver markets are supposedly on behalf of customers, which means they have a pretty good idea of what the customer book is. So as an example, let's say silver is trading around $20.05, and a lot of people have stop orders basically that if silver goes below $20, it triggers a sell. So you can put pressure by, hammering any of the bids, and then once it breaks through that 20 mark, often it will gap down. And as Ted Butler has reported for years, amazingly, the same banks that are selling the contracts are always the same ones buying it back at the lower price, as all the people who had their stop orders in there get basically ripped off by the banks. So again, you don't have to take my word for it. Was this a game-changing announcement in that it would actually end the gold and silver manipulation? Doesn't appear to be quite the case yet, although just interesting in that there was a fellow named David Liu who reached a settlement, I'd say mid last year, of which, at least the way it was phrased, seemed that part of his deal was to provide information and cooperate. So I've lost most faith in the regulators at this point. I mean, I don't know what other evidence you would need than what has been uncovered already, yet at least to the degree that if the regulators want and are going to continue to actually regulate, God forbid, I mean, this is just the tip of the iceberg. And whether the regulators do that or not, eventually I continue to believe the market will take care of that for them, because to continue maintaining this scheme does require some physical metal and brings us closer to the point where someday someone shows up for their bar of gold and silver, it's not there, and then we finally see crypto-like pricing in the precious metals markets, which I'm certainly excited about, hoping that it's 2018. I think it is likely to be, but we shall see. But in either case, that's why if you actually have physical gold and silver that you can leave there for at least a couple of years without needing to touch, perhaps even more so than the cryptos, I think that's possibly the safest investment, if simply because the cryptos have already gone up a lot, where gold and silver are trading at around what it costs to get them out of the ground. So you do have a good natural floor there. And certainly, I'm glad I own some metal as well, and think that's a good step for people to take. And with that said, we're going to wrap up for today. But again, I appreciate you watching. Hit the subscribe button, leave any questions you have below, and then go out there, have a great weekend, and think it's all going to work out okay somehow. Fortunately, these are the steps of how you can take control of your own situation rather than counting on any congressmen or presidents or bankers or anything like that. And with that said, thanks again for watching. We will see you next week.